boss.
Okay. So let me just create an illustration. Then later we are going to finalize when I take you now on the VIX 75 market chart. Okay.
Okay, boss.
All right, sir. So here is how the market works. You will discover that the market is all about understanding the structure of the market. There are two types of structures. We have a ranging market structure and we have a trending market structure. The majority say that they are trend market traders. But when you ask them, few of them will understand what they are talking about. So here is how a trending market looks like. You will discover that the market will begin something like this: swing low, swing high, swing low, swing high. Later, the market does this. The moment the market breaks above this ranging market structure, this is called a ranging market structure. And then the market will make an impulsive move up, break of market structure. It creates a new swing high or supply. Then the market will make a retracement. The reason why the market is making this retracement to the downside is to come and retest two things: the break of market structure, to retest this level. Secondly, to come and establish another level, because the Forex market is influenced by two levels: supply and demand. If you go even on the physical market right now, you go in the shops, it is all about supply and demand. When there is so much demand of something, the price will be hiked. When there is so much supply for something, the price will be lowered. So we take advantage of these price fluctuations. So if the market drops, we know that it has reached on the demand and we must buy. In order for the value of something to be appreciated, what market makers do is that they will buy everything from you at the lower price. When they buy, the market will start shooting up. Why? Because let me give you an example. If you have almost 70% of Nairas in your country, you have them in your account, you are going to make that money, that currency of yours, limited only to a few people. So as a result, a lot of citizens will begin looking after that money. In them and their effort looking for that money, its value will be boosted. So let's say if you had, let's just say an example, you had 100 million or billion Nairas. And then the moment you had that billion Nairas, if it was going, let's just give an example. If it was going, how much is 1 Naira per dollar in Naira? That side, how much are you buying $1 per Naira that side?
Black.
Come again?
10 Naira.
10 Naira,
Black.
nice. So let's say
600 and Naira. Black market.
600.
I'm telling you, 600.
Wow, wow. So let's say if you are buying $1, $1 pay that amount, let's just say 600 per $1 in your country.
Yes.
And then $1 is equals to 600 Naira. So if you got that Nairas, let's say you had 1 billion Naira in your capacity, then people start looking after it because it becomes now, you have created deflation where there is so much limited of supply. So as a result, if you bought that dollar, all right, if it was going around 600, you will discover that Naira is going to appreciate. As a result, it will drop from 600 to somewhere around 400. As a result, the value of that money is going to increase. You are no longer going to have 1 billion Naira. It is going to increase and you're going to have so much interest on top. That's what George Soros did. Now let's talk about supply and demand. Remember, I talked about this level as a ranging market structure. From there, the market managed to break above this ranging structure. It started and created this impulsive move up. It created a level of supply. It is a principle that each time the market pushes up, creates a new supply, it must drop to come and create a second level, because the market is influenced by two levels, supply and demand. And the other reason why the market dropped like this, it is to come and take out trades for buyers. Why? When the market broke out and above this structure, there were people who enter. There are always people who love trading breakouts. They will start buying, believing that the market will continue. So when the market made this retracement, is to come and take these guys out. After they are taken out, the market will now start pushing again. This time, the market will aim to come and break this level of supply. It will go and create a new supply like that. After it does that, it will initiate a move to the downside by creating a new retracement to come and create another retest like that. Again, the market will push. The moment we see something like this, we've entered into another phase called trending market structure. So this is a trending market structure. It is where now you guys who love using trend lines will even try to draw something like this, because now you know that the market will come and bounce there. Later on, the market will do what? Will proceed to the upwards. So now, here is the thing. The market came from this zone, which was a ranging market structure. And this ranging market structure had the level of supply and the level of demand. So these two levels are important. So when the level of demand, this level of demand, we're going to do and say supply, sorry. When this level of supply was broken, we immediately entered into a phase called break of structure. So that is the break of structure. Why? Break of structure occurs when the market breaks above or below the swing highs or low. So these are swing highs, these points. These are swing highs, and these are swing lows. These are swing lows. So the same swing highs and lows, they are the ones that also act as a level of supply, demand. Supply, demand. Now, what happens is that when the market breaks this level of supply, in the future, should the market retrace, this movement is going to be inhibited and prevented from continuing to the downside. Why? It is because the same strength that made this supply here will be now flipped to act as a demand here. As a result, the previous level of supply will turn out to be the level of demand. As a result, the market will create a demand right there and will push. So when you see something like this, you will discover that most of the time, the previous supply will always be acting as a demand. Because in case you ask yourself, the market broke the structure, and then where else is it going to create a demand? All right. So since today we are talking about the basics of the strategies, let's just talk about this. So when the supply gets broken, it is possible that the supply will turn out to become a demand, because when the market went up, it went and created a new swing high there, also known as a supply. All right. So we are going to mark this and label it as a supply like this. So since this is a supply, the market creates a new supply. And what happens is that when the supply is broken, it becomes invalidated. It is no longer a supply. So the market has broken this one. So another example that I can give you is like, if you were buying 1 kg of sugar, let's just say at 2 or 100 naira, your currency, and then that is an example. And then that level, that supply, which was limiting you guys just to buy 1 package of sugar at 100 naira, it gets broken. That means you are no longer going to be buying that 1 kg of sugar at 100 naira, you are going to be buying it somewhere around 150 naira because the supply that was limiting the price from a high, or you guys buying that 1 kg of sugar at an exorbitant rate is broken. It is now going to create a new supply. As a result, you are no longer going to be buying at 100, but at 150. Is it making sense? So what will happen now is that the market has created a new supply. And this new supply, after the market creates a new supply, it must now again drop down to come and create a new demand. So when the market drops down to come and create a new demand, the market has been created to use the previous movement of the market to determine the future movement of the market. So when we look in the past, we will discover that this year was acting as a supply. And it is possible that the market came and created a demand, bounced there and went up. I will take you on the row chart, you'll see. So again, even here, the supply was created. The market came and created the previous level of supply, became a demand right there. Let me show you right here. The demand was created. Even here again, the supply here was created, a new supply, and the supply became a demand. So this supply here became a demand, supply, and then from being a supply, it became, it turned out to be a level of demand. Let me show you. It turned out to be a level of demand. This one here, copy paste, demand, and then from this one again, this one became a demand here. That is how the market moved. I will show you, I'll prove this to you. Even here. Now, how can you trade this type of movement? If you want to benefit and become profitable trading volatility index 75, you must always look to this type of movements because the market has a tendency of using the previous level of supply, a demand, or the previous level of demand to act as a supply. Now, how can you trade? How can you enter? You must always wait for the break of market structure, and then the market will make a retracement. So your chance to get into the trade is to enter when the market makes a retracement. What does the principle of the break of market structure states? The principle of break of market structure states that once the structure gets broken on a higher time frame, for instance, if you happen to be a day trader like me, your analysis should begin on a 4-hour time frame. So if you see that the structure here was broken on a 4-hour time frame, and you see the market making a retracement like this, you must take a chance and be patient enough in order for you to place a trade right there. Because what happens is that if the previous level of supply gets broken, it will now swap, all right? So we call this level a swap zone or a flip zone because it is a principle where the broken supply becomes a demand. It is a swap zone or a flip zone. It also means that the same strength that acted as a supply here will be swapped and will become as a demand. So it means it will be difficult for the market to break this level because it has become now a demand. As a result, the market will push up. So now people will always be buying on retracement this year, this year, this year, and also here. To make matters worse, if you also use a trend line, this is where a trend line makes sense. So a trend line, something that many people have never known, is that a trend line connects what we call anchor points. And anchor points are swing highs and lows, swing highs and lows, swing highs and lows, swing high here, and also lows. So these anchor points are the ones that creates the possibility of this trend line. A trend line is a dynamic level of demand, or a support. Now, how can you trade this? because market makers, they know the reason why they always makes the market to retrace is that when retail traders entered here, all right, they saw this as a consolidation. As a result, when the market broke out like this, these guys understood that whereas the market, the retail traders, other big institutions, always wait for a new candle to be formed on top of this supply because they consider this to be a breakout. So people will start placing buy, and leaving their stop losses. So these guys, the bigger investors on the market, they understand because we only make money when the other part loses money. That's the way it is. So they will know that if we create this retracement, we are going to whoop these guys, all right? They will lose their money. As a result, when these guys loses their money, by virtue of the market making this retracement, they will be taken out and their stop losses will be hit. So when these are taken out, their money will remain in the suspense account called dumped fund or suspense account. So for this money to be collected, market makers will consolidate, create a demand, and push the market up to begin collecting these dumped funds. As a result, when the market is pushing like this, they will hit every and take every money which you and I lost. And the market now will have so much power and be loaded with so much power, buying power, to break this supply. The market will push and go up again. When it reaches there, it will create a new supply, and then it will make a retracement like this. That is what happens. Now, there comes a time when now everybody is busy saying, now, if you are in a signal group, they will say, if you missed here, make sure you buy here. The market is going to retrace to this trend line. Buy here, the market is still going up. People will be flocking to this level. And when they buy, they'll leave their stop losses below, thinking they are safe. So what will happen now is that the market will push, reach that level, and then you see the market again making a return. So people be like, the market will use this trend line here to bounce. And people will be ready to buy here. Some will even set their buy limit order or pending orders. But you discover that the market proceeds to this level again. So once the market reaches this level, you see that already these guys who bought at this trend line have already lost their money. So now, guess what will happen? Now trend lines traders are in trouble here, because now they will believe that if the market retraces, it is going to use this trend line, hit it, and then it will bounce. Guess what? That's not it. Again, they will take your money. People who sold here left their stop losses on top. The market will continue pushing. It is now reaching this level here where it created these swing highs. This is a third swing high. Now, after this, these guys also who trade now, sell high and buy low, will be willing to sell there. And the market will drop. As the market is dropping, buyers who buy low will be willing to buy it. But guess what? The market will just do something like this and then hit a drop. The moment this happens, it is also known as the break of structure. Guess what? People here have lost money. Now, where do you and I come in? How do we begin to trade? We always wait for the structure to be broken. Now, here, the previous level of demand here will become a level of a supply. The market drops down to come and create a demand. It is busy creating a demand. After that, it will go up to make a retest, using the previous demand to become a supply. We must be ready to sell at that level, and then the market will begin dropping. Are you able to get the points?
I'm getting it. Yeah, very.
That's fantastic.
Getting,
so now,
I'm very getting, sir.
Sometimes you discover that the previous level of demand won't be respected. The market may go a little bit above. But I want to take you step by step. Tomorrow, that's what we'll be talking about. But for now, just know that we are going to use the market as a tendency of always bouncing on the previous level of demand, creating a supply. Also on the previous level of supply, creating a demand. Let me take you on the VIX 75 chart so that you can see what I am talking about. So this is the VIX 75 chart. VIX 75. Can you see this chart?
Yeah, I can see that.
Okay, fantastic. Let me just make some properties. I just change the background. I'm going to give it black, vertical black, horizontal black. I love something that looks like this to avoid a problem. Now, when we look at this, let me take you on a 4-hour time frame. We want to begin analyzing on a 4-hour time frame. So remember, as a day trader, you must always use a 4-hour time frame to create your analysis. So the first example that I'm going to give you is here. So here,
okay.
you are going.
This is volatility 1000.
Oh, thank you for reminding me. Let me. Okay, this is VIX 75 because the strategy that I'm sharing with you, you can trade any market. It is the same principle that you can use to trade crash and boom as well. That's the power of it. So when you look at this, you discover even here, let's just start from here, how the market started moving from this level here. So this is the structure. This is how you mark the ranging market structure. And it also has its level of demand. I will give it white color, like that. So this is a demand here. Now, listen to this, sir. Let's just say you and I, we miss this movement. The market dropped. And then you're saying, how am I going to enter? I miss this movement. The things that you must understand is that the market is always you determining the future movement of the market using the past. So this is the past year, and we want to determine what will happen in the future. So this year is a demand. Let's label this one as a demand. So we'll name it a demand zone with this red text. So from there, this white line, I will extend it like this. Now, you discover that the previous level of a demand turned out to be a level of a supply here. And the market, both here, the market bounced at this level here, dropped at this level here, finally made a drop. Again, we are going to mark this level here as well. We'll mark these levels like this and also here. What will happen is that if I mark like this, I do like this, this also was a demand, but in the future, it turned out to be a supply right there. Is it? Are you able to see how this is happening? So the market used the previous demand. Since what happens is that this demand or swing low here was broken, the market came down. They created a new low or demand, and they said, guys, we need a supply because the market is moved by supply and demand. If there's so much demand for something, the price will hike. If there's so much supply for something, the price will drop. That's how the market works. So here, these guys created the demand and they went back up. They were busy saying, where are we going to create a supply? So now what they did is that they used the previous level of demand to create a supply here. Guess what? The market even here confirmed this amazing candle here. It is like a bearish pin bar or a shooting star. That candle right there. So these also are going to help you, your entries. As you can see, this candle here is a bearish pin bar. It was a sign enough that these guys have used the previous level of demand to establish a supply here by also creating this pin bar. All you have to do is to be patient. At the same time, if you really look at this, you will discover that on a smaller time frame, this level here, a pin bar, is going to show you some powerful on 1 hour time frame, some other chart patterns because that is what these guys did. So let's try to go on a 1 hour time frame. You are going to see something different. So on a 1 hour time frame, look at this. On a 1 hour time frame, the market gave us a powerful setup, which is a head and shoulder. This is the left shoulder, the head, the right shoulder, the market dropped. So again, let's go back on a 4 hour time frame. So that is how the market, market is.
Wow.
Yeah.
Wow.
So you discover that
it looks like a magic, I'm telling you.
Yeah, you see, that is how the market works. So now again, you discover that, let's just say you and I, we missed this move from there to here, and we say, what? We shouldn't miss this move. The market may continue going down, but how are we going to enter? Again, you discover that the market is all about structure. This is now a ranging market structure. Wow. Again, we are going to use the previous level of its demand here. We are going to do this. You discover that the previous demand here became the current supply here. Guess what? We would have been ready to sell here. And to make matters worse, if I even try to mark this bearish order block, you even confirm that you could have really sold this at this level. I do this.
Yes.
This bearish order block,
the
this
wicks,
last
yes.
bullish candle here.
I can see the wicks. Yes, I can see the wicks.
You should have sold right at this level here, because there was this supply plus the bearish order block. Look how the market started. The market dropped. And at the same time, if you miss this move here and then you want to sell, you should have waited for the market to break this structure. Now, again, this time you discover that this here was a level of the demand. This was a scenario that I talked to you about now. Now,
yes.
If you find yourself in this scenario, this is where now tomorrow when we start talking about order blocks, you discover that if we try to mark this order block, we mark it like this. I'm going to give it a white color shade like this. The market bypassed the previous level of the demand and it went located straight the target of this bearish order block.
Bearish order block, yes.
It was at this bearish order block that these big guys had placed their entries. So when the market says that they have entered an area that belonged to big investors, it had no any other option but to start dropping. And the market did what? Dropped.
Wow.
Again, you discover that if we try to mark this area again, this ranging structure, we mark it like this, you will see that the previous level of its demand here became a supply here. And also here, the market dropped. So the market will always use the past movement of the market to determine the future. In short, what I'm trying to explain to you, sir, is that trading, the analysis of trading is more of using what happened in the past to determine what will happen in the future, because the past will always affect the future.
Wow.
So again, if we come here at the current, because you had placed some trades, you entered some trades, you were in a sell on VIX 75, and we want to understand why. So the other thing that I want to also emphasize is that you must always start on a higher time frame. So for instance, if you begin your analysis on a 4-hour time frame, it is so much important that you go on a daily time frame to understand and have a bigger perspective that you cannot see on a 4-hour time frame. So for us to know where the market is coming from and where the market is going and the current position of the market, it is important that we go on a daily time frame, which is 24-hour time frame. So on a 24-hour time frame, we have a chart that looks like this. And we can see that way back in the past, the market is coming from this zone here. It dropped, came, went back, dropped, created the demand, went back again, dropped, created a W or a double top like this, and then
Yes.
the market
Double
started
bottom.
pushing up.
Buying.
Yeah. Now, after we know this, we can also tell that the market is coming from a very strong level, this level here, which if we try to extend it like this, it is going to show us everything that happened in the past. Now, when you look at this level, which the market bounced here from, you discover that in the past, it was a supply, demand, supply dropped, demand. It is a swap zone. And the market has used this same level for so many times. As a result, the last time here, it was a demand here, push the market up, demand here, push the market up, demand here, push the market up. Just some few days ago, I was teaching somebody about this same thing. I told them that the market was going to go up. And now they are saying you saw it nicely, because I saw that from the past, this level has been acting both at a demand supply, which means it is a powerful level that you can trust. So now, after we know where is the market coming from, that is the question. The market is coming from the demand, and it went up, reached this level of a supply, and then it created this retracement. After you see that the market created this retracement, we know what is happening. Let's now try to switch to 4-hour time frame. You'll see a different scenario. So on a 4-hour time frame, you discover that you are saying and thinking the market is selling. Yes, you saw nicely. But if you see, the market has been breaking structures.
Yes, it broke the structure.
This structure was broken. Let's give it a color. Let's just give it yellow. Also, the market broke this structure as well, pushed up. So after doing that, the market...
Hello, boss. Hello, boss. I don't know. How do you spot the structure? That is my problem.
Well,
how do you spot the structures?
Yeah. Vanasari, just or I'm so sorry, sir. Now,
Okay, sir.
When you look at this, a structure, these are structures. You can also call them consolidation. This is a structure here. This is a structure. This is a structure here. So these are structures. When we say break of structure, the market broke below and came down. Break of down, like again, broke above, came and create a retracement. So that is what you should always know. Now, since we are dealing at this current price, all we have to do is to mark the structures that the market had broken on a 4-hour time frame. Broke this structure, went up, broke the structure, pushed up.
Went up. Okay.
Again, from that time now, we are looking, where is the market going? And why did the market drop down? If we go back in the past, we do this, we mark this structure. You discover that the reason why the market is retracing, it went back and found this broken structure, which it cannot break just easily. Then the market made a retracement. So now, after we look at this, let's just try to extend this structure, which the market broke in the past. And after the market reaching at this level, within this structure, we can see that the market is consolidating. From there, we now try to go on a 1-hour time frame where we are going to have another perspective. Because on a higher time frame, we can see that the market is still bullish. All right, so the market is still bullish. When we look at this, this is on a 1-hour time frame. And these, if we try to do this, you'll discover that within a bigger structure, there are also these small structures, this small structure, and also these small structures. Within a big structure, there are also small structures like these ones. So after we mark them, We're now trying to understand where the market is trying to go, because right now, as we speak, this here is a level of a demand. And also for the structures, we have this demand for this structure, and we also have this demand for this structure as well. Now, when you look at this, the reason why the market is showing as if it is going to drop, if we try to mark the structure here, we do this, and then I extend it like this, you discover that the previous demand for this structure is acting as a supply at this structure. So after that, on a 1 hour time frame, we now try to go on a 30-minute time frame. On a 30-minute time frame, we are going to have a different overview of the market. So this is a 30-minute time frame. 30-minute time frame is showing us that the market has already broken this structure, and we are expecting the market to continue dropping to the downside. And also the demand for this structure here, like this, though was not respected to be a supply, but the market dropped. So for this one, this is where you can see the different perspective. On a 24-hour time frame, which is on a daily time frame, this is what we are seeing. We are seeing that the market created a double bottom, or a W, and we're expecting it to continue pushing up.
To buy.
To buy. But if we try to bring in the structure as well, we'll do this. You'll discover that this is one big of a structure. We do this. Here, this previous demand became a supply, and also the market bounced using the bearish order block, this one here. No, that's not the bearish order block. For this
the
one,
blue, the green one.
No, there is no bearish order block.
There is.
No.
I thought the green one is the bearish. Or
the only order block that we can count here is this one.
Oh, okay.
Because if you look at this one, when the market broke the structure, it formed another green candle, another one. It was a little bit complicated. So an order block is considered to be a powerful order block. After forming the last bullish candle, it has to continue forming bearish candles to show how powerful the movement was. So that is why I'm saying at this structure here, there is no order block. If you try to mark, then you can just mark this one, because it tried to drop 1, 2, 3. Although even this one never even managed to break, like showing a huge move to the downside. So I would just say there is no order block. The only way that made the market to drop here was the structure. They just came, break, retest, and then continue to drop. So you get the point, right?
I get the point. Yeah.
Tomorrow you will understand more about order blocks. So now, after we look at this, we are also now going to mark the bearish order block, this one here. And then we'll do this. The reason why the market is dropping here, it is because of the presence of this bearish order block here. That is why the market is dropping. And also rest assured that NASDAQ has a tendency of always making a fake breakout above or below order blocks, because NASDAQ is always, have that type of nature. So you don't have to worry so much.
I've not even traded before.
Oh, sorry, not NASDAQ, VIX 75.
Okay.
Yes, sir. So now, on a 1 hour time frame, we are going to have another order block of its own. So for this one, we have this big structure on a 1 hour time frame, this one here. And then for this one, we want to look for the order block. This here is the bearish order block, this last green candle here. This one, we mark it below and above. If we do this, you'll discover that even though this was the order block, VIX 75 bypassed it. Why? VIX 75 has always have had the tendency of always bypassing order blocks. So that is the reason why when you see this type of structure, you don't have to rush into entering just because you have seen it on reaching the order block. You have to wait. Let the market finish reacting. You even see yourself that now it is time for me to sell after you see and wait for the market to completely finish making the reactions. So from there, we'll now switch to a 30-minute time frame. On a 30-minute time frame, you will see the reason why you could have taken a trade here. You're going to see a structure which you were unable to see on a 1-hour time frame. So look at this. So this is a 30-minute time frame. Another structure here was broken. This one, the market pushed and went up. When the market reached here, they knew that they were within this bearish order block, the white marked line, this one here, on a 4-hour time frame. So they knew that they cannot proceed. So on a 4-hour time frame, if I take you, please follow how I'm analyzing this. On a 4-hour time frame, you look at this. This is how a 4-hour time frame looks like here. So look at this. We marked this structure. This one, let's do this. This structure on a 4-hour time frame. And now we try to mark the bearish order block on a 4-hour time frame. I'll give it a yellow color, and then I'll do this. Look at this. Even on a 4-hour time frame, the market bypassed and make a fake breakout a little bit. But even though it was a fake breakout, the market respected the marked area of this ranging structure. It just made a little bit break and then started rejecting. When you see something like this, just know that they are trying to grab liquidity. It means there are those people who love long-term trading who sold and left their stop losses on top. As a result, attracted this move above to go and hit them, then later issuing a drop. You get the point?
I get a point.
Okay, so now after that, let me also show you finally from a 24-hour daily time frame. Then we can go on smaller time frame and try to understand where the market is going, because so far so good. On a daily time frame, the market must continue pushing up. Okay, so this is a 24-hour time frame. This is a 24-hour time frame. So on a 24-hour time frame, you can even tell that the market also bypassed this bearish order block on a daily time frame. All right. Although on a 4-hour time frame, the market bypassed it, but the market respected the daily order block, this one. It just made a little bit of the break of this structure, and then the market later dropped. So from there, that is why always remember to be switching between bigger time frames. Trust me, you're not going to be missing. So we were on a 30-minute time frame. On a 30-minute time frame, this is where the chart, we have a chart looks like this. So on a 30-minute time frame, we are expecting the market to drop. And now this type of movement, let me delete everything. We are expecting the market to drop because this is a broken structure. And the market now created a new bigger structure down, right down below. Like this. Like this. So now with this one, this is on a 30-minute time frame. So this is where now a lot of people who love using, they love using, you know, sell high and buy low. But don't do that. Just have to wait, because the market now is going to fail to reach that level that far. What is the reason? If I mark this with a yellow white area like this, you discover that there is a bearish order block. This one.
Yes.
This one is a bearish order block. So as a result, within this area, we will expect the market to do what? to start showing some rejection and later on issue a drop to the downside. So after that, you now be ready to prepare your entries on a 15-minute time frame.
Wow.
So on a 15-minute time frame, you have this now. All right. If you want, you can let me try to remove everything. You can even try to analyze now. You will see that there is this structure which the market broke, and now they use this bearish order block to break it like this, also like this. So on a 15-minute time frame, the market, this is when it is approaching the bearish order block. And also we can even say that they have bypassed this area, which is supposed to be a level of demand. They have bypassed it. They have gone to retest the bearish order block. It is now on this 15-minute time frame that you'll be ready. Even if you see the market showing some rejections, just to relax, wait, the market will still continue. It has to reach inside that bearish order block, and then you can be ready to do what? To sell. Just remember, VIX 75 has a tendency of making fake breakout and then later reject, continue to drop. Any question?
Thank you very much, sir. Yeah, I'm well impacted to at least this evening. Yeah, well, the only question I have, then the question I have is this. On the, what's it called, the order block?
Order blocks? Yes, sir. Hello, can you hear me? Hello? I can't hear you.
Hello?
Yes, sir. Can you hear me?
I can hear you. Can you, sir?
Yeah, I can hear you now.
Okay, sir. Yeah. I said this order block.
Yes, sir.
After you do this order block.
This one, yeah.
Yeah. Then this green one, this bearish. Okay, this bearish order block determines the future of the next candle.
Mm-hmm.
Am I right?
Yeah. Okay, for
that,
this one, I just want to save it specifically for tomorrow, so that since if we talk about these order blocks, it is important that we keep the fresh knowledge that we had learned in the first time we started. So I always teach order blocks specifically for the dedicated second day, so that you are going to get a full rich knowledge about the order blocks.
Wow.
Yeah, because if we start talking about order blocks, you're going to focus on them and you forget on the other part. Yes, sir.
Okay, so no problem, sir. Then maybe from tomorrow, I will ask questions. Okay, what about, I asked, what about some trader? They call them, is it shoot entering or a sniper entering?
Come again?
What's it called? A sniper entering.
Oh, sniper entry. Yeah, sniper entry.
Yes, that sniper entry. Is it advisable? Is it advisable for a trader?
Sniper entry, yes, is very much good, especially if you've gained full confidence of the strategy. It's very much good. Yeah, because for instance, right now where the market has reached, you can try, you start placing on a demo, you can enter here, and then you see the market rejecting. That is a sniper entry. Or you can wait for the market to drop and then you enter. That means you're a conservative trader. You wait for the market to finish reacting. But sniper traders, they will enter right here inside this order block. All right, they can enter here, they can enter here, they can enter here and sell, because they trade based on what they are seeing on the market. Yes, sir.
Sorry? Eh?
That's how it works.
Àgbàdo wà lọ́dọ̀ woman tó máa ń ta níbi street wa náà. Street wa nínú street wa. Woman tó ń ta oúnjẹ. Wá tó bá rí máa bọ̀ ń lé. Ṣé wàá ti rí ìgbálẹ̀ àti kìíní? Ó dàbọ̀. Mo wà nǹkan. Tó bá tí wọ́n jù. Hello, sir.